Okay, hi everyone. This is going to be the third lecture for chapter 25. So I think we ended right here with the federal estate tax. This is where we're going to be picking it up. So as I have here, the estate tax is designed to tax the value of property owned by an individual at their death. The decedent, so the decedent is the person who passes away. Because the federal gift and estate tax are integrated taxable, gifts are going to affect the tax base for the estate tax on Form 706. Okay, so we're going to be talking about the estate tax. When we say the decedent, we mean the person who passed away. We're saying the estate tax is Form 706. Now, this is a kind of more nuanced way of spelling it out. I have here basically your gross estate minus your deductions gives you your taxable estate. And we'll look at each of what these means as we go through. So the gross estate, right? What we're talking about here is basically the estate tax, and we said we want to look at the property you transfer at death. So property owned by a decedent at the time of death is generally referred to as the probate estate. The reason being is the transfer of this property happens in the probate court. Now, an executor will be appointed by the court and they're going to carry out the will. If there is no will, the person's going to be considered to have died intestate. And if they have a will, they're going to be considered testate. So you have a will, you're considered testate. You'll have an executor who carries out that will, who's appointed by the probate court. If you're intestate, you don't have a will, what happens, not to go too much off the beaten trail here, is they have intestacy rules where the court will follow a certain lineage, maybe your parents first, then your brother and sisters, or if you have children. They have a prescribed order of operations for how they distribute your assets if you're intestate. In any event, right, the probate here, if we're talking about the word probate, this is basically the process of gathering property owned by the decedent, paying off any of their debts, and transferring any of the remaining property to the heirs. So if we look here at 2512, looks like Nate took an inventory of his father's personal property at the time of his father's death. And it looks like it included all of these items, $20 million worth of things. So what's included in the gross estate? Basically the value of all of the above property. It says here, suppose Bob was entitled to a pension distribution of $15,000. So the father who passed away, he didn't receive the check at the date of his death. Would this also be included in the probate estate and therefore the gross estate? Well, yes, because he was legally entitled to it at the time of his death. So we mentioned these words there, kind of gross estate and probate estate. The gross estate basically is the fair market value of property that's owned. And it also includes property that is automatically transferred that happens at death. And basically the second category, these aren't going to be included in the probate estate because the transfers occur upon death and there's no need for the probate court. So it's an automatic transfer. And we'll look at some of these here. So with regard to the gross estate, right, we said certain properties are automatically transferred at death. We don't need to go to the probate court to transfer those. One example would be a joint tenancy, right? So jointly owned property. So if you have joint tenant with a right of survivorship or a tenant in common, what happens here is, let's just say A and B own property as tenants in common. A dies. And what happens is automatically B is going to get the full ownership in that property. So these items, while they're not included in the probate estate, are going to be part of the gross estate because they're property that, while not needed to be administered by the probate court, are part of that gross estate. So if we look here at 25 13, right, it looks like Nate and his father owned 2 parcels of real estate that wasn't in the inventory from the last example. It looks like they own 1 property jointly, and it's with a right of survivorship. Will this property be included in the probate estate and or gross estate? Okay, basically the idea here is when father passes away, it automatically transfers to son. It's not part of probate estate because it's automatic. There's no need to invoke the probate court. However, it is part of the gross estate because the gross estate is a broader definition and includes these automatic transfers. It says here, with regard to life insurance proceeds, these may automatically be transferred at death as well. And the proceeds from life insurance can be paid due to the death of the decedent, are part of the gross estate if either the decedent owned the property or the estate or executor is the beneficiary of the policy. So let's look at 2514 here. Looks like Bob, he owned and paid annual premiums on an insurance policy that on his death was to pay a beneficiary 500 grand. He named his son the beneficiary. And when father passed away, looks like son received the 500,000. Basically, will this 500,000 be part of the gross estate? Well, basically, this is one of those automatic transfers that happen at death. And it will be part of the gross estate. It says here, suppose the father transferred the ownership of the policy to the son 4 years before his death. Son had the power to designate the beneficiary of the policy and also pay the annual premiums. Then would it be, it says, will Bob's gross estate include the value of the insurance proceeds to son? No, in this case, the father had no ownership interest at his death, and the proceeds weren't paid to his estate. So basically, traditional life insurance policies, you pay a premium each month, you name a beneficiary. At your death, property, the cash under the policy automatically transfers to that beneficiary. That will be part of your gross estate. Next thing in here. Talking about value of jointly owned property. So we have 2 type of tenancies here. When we're talking about tenancies, we're talking about ways of describing property ownership interests. So we have tenants in common versus a joint tenant with a right of survivorship. When we're measuring these automatic transfers that are part of gross estate, if we have tenants in common, the proportion of the value of the property is included in the gross estate. So basically, hey, we said, let's just say we have 3 individuals, A, B, and C, who equally are 1/3 tenants in common. When A passes away, we're going to say the property automatically transfers to B and C. We said that's an automatic transfer. In this case, because we're a 1/3 owner, 1/3 of that total value of 120 grand, namely the 40 grand, is going to be part of our gross estate. So it's not part of the probate estate, but it's part of the gross estate. Joint tenant with rights of survivorship, you can look at that. Not as concerned about that one. Another thing here that's interesting when we're looking at the gross estate is going to be transfers within 3 years of death, right? So as I have here, transfers of life insurance policy made within 3 years of the decedent's death are also included in the decedent's gross estate, but are valued at the time of death. I have here, if the decedent does transfer the property in the 3-year window before death, then any amount of gift taxes paid on the transfer is included in the gross estate, because had the donor not made the transfer, the money used for the taxes would have been in the estate. So what does all of this mean? Like I said, I can just read this off to you, but I can tell you in a kind of simpler way about it is, we said that life insurance proceeds are part of the gross estate, which means that they could be taxable if you're subject to the estate tax. One thing a person might try to do is, we could sell the life insurance policy, or basically get rid of it in such a way, or transfer ownership so it's not part of our gross estate. Well, you can do that, but you can't just do it at your deathbed to avoid paying estate taxes on it. In other words, they have a look back, a 3-year look back, and they say, did you transfer this within 3 years of your death? If so, we're going to include it in your gross estate. So let's look at 2516 here. It says, suppose Bob owned a life insurance policy and he transferred all of the ownership interest to his son 1 year before dying. Suppose that the son paid $40,000 of gift taxes on the transfer, and the policy paid his son. I'm sorry, it says, suppose your father paid $40,000 of gift taxes, and the transfer of the policy paid his son $3 million at father's death. What amount would be included in Bob's gross estate? Basically, what you're going to have here is the value, because they transferred it within 3 years of their death. It's in that look back window. We're going to include all $3 million in the gross estate, and we're also going to include the gift tax that we paid on it in our gross estate. Because basically, that money would have been there had they not made the transfer. Next couple items here. It says valuation. Generally, right, what you're going to value all of this property at. So you die, we look at your gross estate. We said it's basically what you own at the time of death, but can also be some of these automatic transfers that happen. Generally, general rule is going to be how we value it is the fair market value on the date of death. So that's what we include in the gross estate. However, we have this alternative valuation date where you can basically look at the value of the property 6 months after the date of death. So let's look at, a few examples here, 17 through 20. It says, at his death, looks like father owned a painting, right? He purchased it for 25 grand, and now it's worth 210. Looks like the son has got it appraised, and it looks like it estimates it's now worth 250. So 1 year ago it was worth 210. Now it looks like it's worth 250. What value should be placed on the painting for inclusion in the gross estate? Basically, this is just going to be the fair market value at the date of death. We had an expert here come in and say, hey, at the date of death, this item is worth 250 grand. Next one here, it says, at the time of his death, father owned a reversion and a trust that he established for his favorite cousin, Becky. So father basically created a trust. It says, to Becky, for life, you get $100 a month, and then whatever at your death, Becky, it comes back to me, father. That's what the reversion is here. Now, under the terms of the trust, Becky's entitled to income for her life, a life estate, and then father's entitled to the reversion. So just like I said. Now, with more specific numbers, it says at the time of his death, father's death, the trust assets were valued at 100. Becky was 35, and the interest rate was 6%. Should the reversion be included at Bob's gross estate? And if so, what amount is placed on there? So basically the idea here is this reversion is a property right that they have a future interest, and it should be included on there. You'd have to use the interest rate to calculate the math on it. I'm not going to ask you a question like that on the exam, but just be aware that it will be included on there. Next one here, it says, at the time of his death, he held some stock that was worth 19.5 million. Imagine that a couple months after his death, it drops to 5 million. Suppose that the drop in value causes the value of the estate to drop from 28 to 13.5 and reduces the tax on Bob's estate. Could the son opt to value the shares at the lower value for tax purposes? So here's the idea, right? Yes, they can. Let's just say on the date of death, these were worth 100,000. You don't have to use these exact numbers, but then 6 months later, they were worth 60,000. So the general rule is going to be fair market value date of death, 100,000. That's what you put in the pot for the gross estate. However, if you elect the alternative valuation date, you say, what is this stock or property worth 6 months after the date of death? In this case, it was 60 grand. So you would pick the lesser of the two because you're going to have a lesser tax base, so valued lower. This is just showing how they value all of those items in light of the previous examples. Okay, so it says we calculate the taxable estate here in 2 steps. So going back here, we looked at what the gross estate is, right? We looked at some of these examples here. Now we're saying we want to get to your taxable estate, which means implicitly we're going to talk about some deductions. So the first thing is we subtract from the gross estate the deduction for administrative expenses, debt of the decedent, and losses incurred during the administration of the estate. Then we subsequently reduce it for the marital deduction and the charity deduction, giving taxable estate. So they basically are breaking out a bunch of deductions into 2 types. The first thing, conveniently, you see the very first deduction they're taking there is administrative expenses. The lawyers, the attorneys, they want to be paid. So looking at the administrative expenses, if these are the first items that are being deducted, these are things that are going to be like debts incurred by the estate, administrative expenses, taxes, funeral costs. And as I have here, the estate may collect income during its administration and thus will have to file an estate income tax return. Regarding the administrative expenses, the executor can either deduct on the estate tax return or the estate's income tax return, but not both. Okay, so let me think of an example here. Anna Nicole Smith, I think, is the classic example. She passes away, so she was like a model from the 90s, and I believe she may have passed away from, maybe an overdose, or I don't know the specific facts, but it was one of these like Hollywood stories that was a big deal. Now, there was a contest about a will contest as to who should get all of her assets, right? Maybe it's her daughter who's 5, or maybe it's a family member. Basically, 2 parties are contesting the will, and this is a very long, laborious process. So let's just say Anna Nicole Smith has $1 million sitting in the bank. We can't do the estate tax return until we really administer this estate, but we can't really administer the estate until we figure out the legal consequences of this will contest. So what that means is it could take 2, 3, 4, 5 years before we're able to actually start to touch this estate, to work with it from a legal capacity, given the will contest. During that time period, right, the $1 million that's sitting in the bank, that's going to be earning income, interest, dividends, however it's invested. Well, in that case, right, the estate itself has made income. So the estate would have to file an income tax return. So this is separate from the estate tax return, where we look at how much tax Anna Nicole Smith may have to pay on this because of her death, the property she's transferred. Versus in distinction, an estate income tax return is a tax return based on income that was generated from the estate. Now, if you have administrative expenses like you're paying attorneys and stuff, you don't get a double dip. In other words, you don't get to deduct those on the estate tax return and the estate income tax return. You have to pick which one. The next couple here, marital deduction, charity deduction. We've talked about these before with the gift tax. It's just a repeat of it. The marital deduction is basically unlimited. It's meant to avoid having to pay tax for transfers to your spouse. Same with the charitable deduction. We can look here at 2522 if we want to see a quick example of it. Basically, in this case, it looks like they gave $250,000. We would just back that out. So we're starting here. It looks like the gross estate. We back out those original expenses, gets us to 21 million. From that 21 million, we back out, in this case, it looks like it was a charitable contribution. So now they're saying to get from the taxable estate to the estate tax liability, we're going to have 3 more steps. So to get from here, the taxable estate, to tax liability, there's a few things in between. And this kind of harkens back up to here, right? This guy right here. Basically, to get from here to here, like down here, there's a few things we have to do in between. So first, the taxable estate is increased by adjusted taxable gifts. We'll define those in the next slide. To compute cumulative lifetime transfers. This is basically prior year gifts you've made, things that you've done during your life. Then the tax on the cumulative lifetime transferred is computed and reduced by tax payable on the adjusted taxable gifts. And then the tentative tax is reduced by the full applicable credit. So basically, one of the things we're doing here, in short, is we're figuring out the tax on all of the gifts you made during your life, as well as the gifts from your death, and then we're backing out the applicable credit. There's some specific mechanics here. Again, I'm not as concerned about these nuances as I am you just understand the overarching framework. So this is showing us, how the interaction between the federal estate tax and the federal gift tax. So as I have here, right, adjusted taxable gifts or taxable gifts other than transfers are already included in the gross estate. That's adjusted by reducing prior gifts for the gifts that are already included in the gross estate. Generally, these are going to be lifetime gifts. And despite the fact that they were made in prior years, their calculations are going to use the current rate schedule. So you can look there at 2523. Then it says here, the applicable credit, once we get to it, we basically have this giant credit, right? This 11.7 million credit that we can offset any liability. So we said this is the reason why the estate gift tax only applies to certain people. But as I have here, right, the applicable credit for a surviving spouse is increased by the amount of the deceased spousal unused exclusion. So let's look here. So for example, in 2021, a surviving spouse would be entitled to an exemption equivalent of 23.4 million. In this case, double the exemption equivalent. So the exemption equivalent is 11.7. I think it's 6 or 4 for the applicable credit. Not a big deal because these are just such gigantic numbers. The idea here being is a surviving spouse would get the 23.4 if the estate of the deceased spouse did not use the applicable credit. So basically, if husband, let's just say you're married, your husband transfers all of his assets to you at death. In that case, he's going to get the marital deduction for all of it. He didn't have to use any of his applicable credit. In this case, you get to double up. When you pass away, you now get his applicable credit and yours. In other words, and the way they adjust this is by basically doubling your exemption equivalent, the amount you can give. So the idea here, the exemption equivalent, we talked about, that's how much you can give before you have to pay taxes. If you exceed it, you're going to have to file the Form 706. And the deadline for the estate tax return is 9 months after the decedent's death. So we know what's going on here is you die on day one, whatever it is. Generally, we're going to look at the fair market value of your property at that date on day one. That's included in your gross estate. We said the gross estate also includes certain automatic transfers. One of the things we can do is with property is we can use an alternative valuation date of 6 months later to value the property. Regardless, 9 months after date of death is when the return itself is actually due. So you have like date of death, 6 months later, you can use an alternative valuation date. 9 months after date of death, return is due. The next idea here, we're going to talk about the GST, that is to say the generation skipping tax. So basically, this tax was enacted to prevent the avoidance of transfer taxes through transfers that skip a generation of recipients. So let's look at this here. Let's say the grandparent gives a life estate to son with the remainder to grandchild. When son dies, their interest in the life estate ceases, and therefore there's no tax on the transfer to grandchild because it was an automatic transfer. Thus, while the grandchild to child is taxed, the movement of property from child to grandchild skips taxation. So in other words, let's think about it this way, right? You have a bunch of money that you want to leave. Let's say you want to leave $20 million, right? We know 11 million of that you're going to be able to use the exemption equivalent on. So we know that roughly $9 million you're going to have to pay estate and gift tax on. And we know that that's a high tax rate. We don't like that. So what we could do hypothetically, right? Let's say we have a son and we have a grandchild. We have two options here. Option one is we can give, the 9 million, the taxable amount, 9 million, to son, right? They're going to have to pay tax on it. But guess what? Then when son dies, he's going to have to, pay estate tax too, and include that 9 million in there. So by the time it works its way down to grandson, goes from grandfather to son, there's one layer of tax. And then when it goes from son to grandson, there's a second layer of tax. So maybe that 9 million ultimately becomes like 6 million by the time it reaches grandson. One of the things grandfather might suggest here is instead of giving the 9 million directly to the son, I'm going to give it directly to grandson, and I'm going to skip you, son. The reason being is we avoid one of those layers of taxation. And basically what happens here is Congress saw people doing this, and they came in and they created this generation skipping tax to prevent people from doing this, basically just skipping a generation, giving it to grandson to avoid paying, taxation on it. And really what they essentially do is with it is they impose the GST on this transfer when it happens to effectively make it the same amount of tax that it would have been had you done both layers of taxation. So the generation skipping tax is basically just that. If you tried to skip a generation, grandfather, give it directly to grandson, we're going to impose a second tax on that would treat it as if you gave it to your son, who then gave it to your grandson. You can't kind of skirt the rules here. Few other items here at the very end, some income tax considerations. So we're going to look at potentially a trust return. So basically a fiduciary, we're going to look at some definitions first. This is someone who takes possession of the property for the benefit of a person. So it's someone who manages property. They have a legal duty to act in the best interest. An estate is a legal entity that comes into existence upon a person's death. And a trust is a legal entity whose purpose is to hold and administer property for beneficiaries. These can be created while you're alive, a lifetime trust, or at your death. So if you have a trust, right, an estate and trust, and it generates income from the body of the property that's put in there, you may have to file a Form 1041. And basically the idea with this is you're going to be taxed on the undistributed income from the estate or corpus. This is different from transfer tax, right? It's an income tax. Basically the idea here is, let's just say you have rental property, you put it into a trust during your life, and it's for the beneficiary of your son. The rental property generates rental income. And to the extent you don't distribute that rental income out, there will be income that's sitting in this trust that there has to be income tax paid on. So the trust itself would have to file an income tax return. It's just like when we said the estate, potentially would have income that it has to pay tax on. So trust documents, as well as state law, are going to determine how income and expenses are allocated to income from the trust versus allocated to the corpus of the trust. Generally, estates and trusts are going to act as a conduit for income received, and taxation is going to be at the beneficiary level through distributions. So normally what they want you to do with estate and trust is to just push the income out from it. And then the people who receive the K-1 from it being pushed out, they'll pay the tax on it. That's going to be the general rule unless it just sits in the trust. And if it sits in the trust and it produces income, like I said, there's going to be a Form 1041. There are deductions on this. So, if the rental property had expenses, they paid interest, they gave it to taxes or charity. The big one here that you get, right, is for distribution of income to beneficiaries. You get to basically wipe it off the books if you distribute it to the beneficiaries. And what they say here is the maximum amount of distribution is the lesser of what was actually distributed, or this DNI, distributable net income, which is calculated through a separate formula. And one thing to be aware of here is tax rates applied to estates and trusts are a lot higher and more compressed than tax rates of individuals. The next item here is serial gifts. We've talked a little bit about this. So a serial gift is a strategy to convert a large taxable transfer into tax-exempt transfers by dividing it into multiple lifetime gifts. And this is basically where you're leveraging the 15 grand per year per donee. Instead of giving it all at your deathbed, where it will all be subject to the exemption equivalent, or all be subject to the estate tax because you're a multimillionaire, dish it out over your life, take advantage of that 15 grand per year per person. You can really give a lot without having to pay tax on it. So that's the idea of a serial gift. Finally here, things we have to be aware of if we're looking at the donee in this case, right? So this whole chapter we've been talking about what are the consequences to the donor or the decedent, the person who gives the gift or dies. How about the person who receives the property? Well, the big thing here that we want to be aware of is basically if you gift it versus you give it at death. If you gift it, the general rule is going to be a carryover basis. So grandfather owns a car. His basis in it is 10 grand. It's worth 25 grand. If he gives it during his life to grandson, grandson will take a carryover basis. So 10 grand. Whatever grandfather's basis in it was is now grandson's basis. If it's gift, carries over from one to the other. In distinction, if grandfather gave it at death, there would be a stepped up basis. In other words, if we bought it for 10, it's worth 25. If we die and give it through our will, grandson will take fair market value at the date of death. It's stepped up to that fair market value. Grandson will then take 25 grand basis. So in that case, it might be better to give it through death, because then there's a stepped up basis. If grandson gets it, it's worth 25. That's his basis. If he then sells it, he's going to have no gain because his amount realized is going to be 25, what it's worth. He's going to back out his basis, grandson's basis of 25, that's stepped up, no gain or loss. And you compare that with if grandpa himself were to sell it, for 25 and his basis is 10, he'd have a $15,000 taxable gain. So with that, we're going to end here. Like I said, I'm more concerned with the basics, terms, definitions, not as concerned with the complex calculations of doing the estate and gift tax return themselves, with like what tax rates to use and things like that. Be more aware of the basics.